In this first chart, what I've done here is to illustrate the Fed's latest revised central tendency economic forecast. And what you can see here, what I've tried to delineate here, is the latest June forecast as compared to the earlier April forecast in the dotted line. So you can see that the Fed has revised downward to some degree their economic outlook. And by the way, this goes out through 2015. But it's interesting to me to note that directionally, they haven't changed their view that we will see increasing economic momentum through the rest of this year and into next year and into 2014. In other words, the rate of estimated GDP growth continues to escalate, to increase, improve over the next 2 years. And so it's not, in fact, a very substantial downgrade, although you can see that it's material. And the commentary that I think was important, I've included on the right side of this chart. Growth in employment has slowed in recent months, and in the recent webinar and commentary, Andy and I have both been talking about the employment numbers very specifically, and also in the context of the president having said the private sector is doing just fine and so forth. Well, the jobs picture has been deteriorating somewhat over the last couple of months, and this has influenced the Fed's thinking. Business fixed investment has continued to advance, noted by the Fed. That's good news. Household spending appears to be rising at a somewhat slower pace than earlier in the year. That's an important point because actually household spending in the first quarter GDP report actually was the bright spot. Household spending has in fact been reasonably strong. One of the other reasons that the president said what he said. But the Fed is noticing some faltering in the momentum of household spending. And then finally, the Fed said today, despite some signs of improvement, the housing sector remains, remains weak. But I want to comment specifically on that last point because of how significant housing is to the economy. And then finally, in their concluding statement, the Fed said today the committee expects economic growth to remain moderate over coming quarters and then to pick up very gradually. And here I picked out the word very, identifying that as having been added to the June statement from the April statement. In other words, but for the word very, the statement was identical. The good news here is that the Fed's economists do continue to believe that we'll see economic expansion over the next number of quarters. In other words, the Fed's not suggesting that we're sliding into recession, but they did add this qualifier saying that their view remains a little bit more muted than what they were thinking in April. How has the stock market responded to quantitative easing? And a related question is, by extending Operation Twist, some people call that QE3, but it's another form of quantitative easing. By extending it through the end of the year, as a matter of fact, stocks have been reacting very favorably. This is a big part of what I think has been going on in the last couple of weeks in the stock market. The stock market sold off by 10% during the month of May, but then has recovered pretty significantly just in the last couple of weeks. I think in anticipation that with weaker economic data, the Fed will, in fact, or was going to, in fact, extend quantitative easing via Operation Twist out through the end of the year from what had been a scheduled end of Operation Twist at the end of June. And so I attribute much of the most recent rally in stocks to what the Fed announced officially today, which is to say a continuation of Operation Twist. But I thought it was interesting to note the history of quantitative easing with respect to the stock market, and here it's really obvious, at least as far as I can tell. The stock market has responded very favorably to the three separate tranches of quantitative easing. What about the bond market? Well, this also, I think, is a very interesting observation. And the note that I've made in the right-hand side of this chart is that quantitative easing has actually worked precisely in reverse to what the Fed has been stating its purpose of QE, which is to drive bond yields lower. Let me say that another way. Bond yields have actually responded to quantitative easing by rising, not falling. And I think the reason for this is that the bond market, with each announcement of another tranche of quantitative easing, has assumed that it's probably good news for the economy. Bond investors have regained some confidence that the economy is not slipping back into a double dip or worse, and hence yields have risen with each announcement of another tranche of quantitative easing. And again, you can see that very clearly in this chart. So I say, at least my interpretation of the chart is that, as a matter of fact, quantitative easing has not resulted in lower bond yields. It's resulted in higher bond yields. I'm not suggesting that QE is a mistake. I think the Fed actually probably has been compelled to try to do something to assist the economy and prop up the economy, and I think in my view, it's been good news that the bond market has reacted the way it has, in other words, with improved confidence and hence rising yields. But I think it is interesting to note that QE actually has not resulted in lower bond yields, which is what the Fed has been maintaining its stated purpose to be. So the last data point on this chart is what you see here. June 20th, 2012, the Fed today announced that it was extending Operation Twist through the end of the year. Now it'll be interesting to see what happens to bond yields. Will bond yields once again move higher with improved confidence in the economy based on the notion that the Fed has come to the rescue once again? We shall see. Because the Fed specifically commented on housing starts and new home construction in today's statement, saying that housing was weak, I did want to show you the most recent May housing starts number that was released on Tuesday. That's yesterday, because this is importantly a very fresh data point. And that's what you see here. And I think what's important to understand is that while the Fed is accurate, of course, in saying that the housing market and housing construction, most importantly, by the way, new home construction, I think, is the important aspect of the housing discussion, because new home construction is what determines whether you're adding to or subtracting from the payroll related to housing. You either hire people or fire people when you're either building housing or laying off and downscaling new home construction. So I think that, as I was saying, I think the Fed is accurate, of course, in saying that housing remains weak by comparison to, for example, the 2 million annual run rate that we saw at the peak of the housing boom earlier last decade. But by comparison to the trough of 400,000 new homes, new units started in around May of 2009, then at something in excess of 700,000, most recently reported, we've actually come quite a distance. The permits number, though, is also the figure that I wanted to highlight in this report. The permits number reported yesterday is, in fact, good news. Permits are a leading indicator of what's going to be started in the ensuing months. And so this trend, number one, has been gradually trending higher. The red dots in this chart represent the Mortgage Bankers Association's latest forecast, looking out a couple of years for this recovery trend in housing starts. But the May permits number also was, I think, very significant, released yesterday. And then finally, the big picture with respect to the backdrop for demand for new housing units in the United States. And you may be familiar with these figures because I often talk about these, but the punchline here is that I have no doubt, at least in my mind, it's a given that new home construction will gradually revert back to something like 1.5 million compared to the most recent 700,000 here. In other words, we got a long way to go to recover, and there's no question we will recover in the rate of new home construction. It'll take some time. But the reason for that is that we add 3 million new bodies to U.S. population every year, and we have needed historically to build about 1.5 million net new units to keep up basically with growth in population over time. We overbuilt here when we were building at that 2 million annual run rate clip. Then we've been absorbing excess inventory for a number of years, and I think we have turned the corner, and we're gradually into reversion to the long-term mean mode of approximately 1.5 million net new starts. Those are my comments for today. I hope that was helpful. But I just wanted to put some numbers to what the Fed's major announcements were today with respect to both their revised economic forecast and their plans for the final or this current third tranche of quantitative easing, also known as Operation Twist.
My first question is, I was doing some research on what you said recently about the ECRI call being wrong. And I called ECRI, the Economic Cycle Research Institute. And interestingly, what I can gather from looking at their blog is they're saying we're likely in a recession right now. Just entered it, perhaps. Their September 30th call, they say it takes 6 to 9 months for their call to be correct. And it takes another 6 to 9 months after that for everybody to know it was correct. How do you respond? Are we perhaps in a recession already?
Well, the quick, short answer to your question is, Andy, I don't believe that we're currently in recession. In other words, all of the coincident economic data that we see week to week, month to month, which, by the way, is why we do these monthly webinars to monitor the most recent economic data. All of that data suggests to me that no, in fact, we're not in recession, and economic growth, while it certainly could be more robust to satisfy all of us, we are by no means in or close to recession. And the key factors that I would point to there are the purchasing managers indices, which I spend time on every month going through those. The reason I mention those is they are the best and broadest survey, they are both broad and reasonably deep in portraying a real-time picture of economic activity. And what the manufacturing and non-manufacturing surveys have been suggesting all the way up through May, which is the most recent data, is that no. And in fact, on both of those surveys, the services survey ticked higher in the month of May, and the manufacturing survey is still at a pretty darn decent clip of 53. So that's exhibit number one. Exhibit number two, as a matter of fact, is the jobs data, which we've talked a lot about in recent weeks. And yes, it was disappointing, but nonetheless, the trend has been, and the data has been, to show that actually we have been adding to total workforce, total headcount in the United States, even though we would all like to see that at a faster clip. The fact that you're adding to headcount suggests that, no, the economy is expanding. And finally, corporate profits historically have correlated very closely with current economic activity. And of course, we only have profits through the first quarter, but S&P earnings through the first quarter actually once again surprised to the upside and remained pretty darn robust in their rate of growth. So as I see it, in a real time, economic activity is not anywhere close to having gone into reverse, having gone into contraction mode. The definition of recession, the commonly accepted definition of recession, is 2 consecutive quarters of economic contraction, negative GDP growth, and nowhere in the data do we see anything suggesting that that's the case currently.
And in terms of extension of Operation Twist, what some other economists have said is that the Fed is pushing on a string. What do you think of that description of what's happening here?
I personally think that the Fed, to some degree, the pushing on a string metaphor is appropriate. In other words, I think that bond yields have, as I illustrated in these charts, and here I'm going to go to this chart once again. The bond yields have collapsed when investors have lost confidence in the economy or have thought the economy was falling off a cliff, and you saw that in 2008. You saw that again in 2010. You saw that last summer, and you're seeing it again. And then when the Fed came around and applied quantitative easing, bond yields perked up. That's a good sign, because that suggests that bond investors are taking heart that the economy is not falling into the abyss. So on the one hand, I think quantitative easing has been a good policy with respect to at least instilling confidence in the market. On the other hand, I think it has had no real effect of pushing bond yields down, which is what it's supposed to do. In other words, make borrowing costs cheaper so as to stimulate the economy through the housing sector and through the banking sector. That, in fact, hasn't actually been the way it's worked at all. So I would say that they're probably doing what they have to do, but it's affecting the markets in a way that I think was unanticipated.
Are there negative implications of Operation Twist that you're worried about?
Not particularly, Andy. I think, you know, the big concern, of course, is in the end, how does the Fed unwind the massive tripling in the balance sheet? In other words, before the crisis, the Fed's balance sheet was $800 billion, and today it's $2 trillion in bonds that are owned by the Fed. So the question and the real skeptics on this whole program have said, well, how do they unwind it? As a practical matter, I don't think it's very difficult for them to do, or they can simply let these securities run off over time, quit adding to the stock of long-term bonds that the Fed owns, and just let them run off. But I don't see any real difficulty in doing that longer term. Well, the Fed is printing money. In other words, the related concern is a big surge in inflation out there somewhere related to this policy of quantitative easing. And for a whole host of reasons, I'm not concerned about that. And I guess all I would say in summary is, well, what does the bond market believe about the inflation prospects? And all you have to do there is look at the so-called TIPS spread, which is a real-time market-based indicator of 10-year inflation expectations. And what the bond market is telling us is there really is not any concern, at least for now, about the longer-term prospects for inflation. And the key reason for that, at least in my view, is unless and until a labor market in this country starts to tighten up, you're not going to have any wage push inflation anytime soon. And wages are roughly about 70% of the total contribution to the CPI over the long term.